Retail traders map static horizontal support lines based on visual peaks from past price history. During high-stress market sessions, these lines reliably and violently fail. Institutional execution algorithms do not look at a chart and respect a manual line drawn 3 weeks ago. They operate instead on dynamic mathematical logic. Market makers control global order flow by continuously measuring localized percentage displacement and standard deviation. Plotting fixed points on a chart forces you to look backward. By the time price interacts with a historical visual peak, the algorithmic liquidity pools have already shifted to a new location. The market operates as a fluid, probabilistic environment. Navigating it requires abandoning static geography in favor of real-time mathematical boundaries. The DRW engine reverse engineers institutional limits. This scatter plot demonstrates the shift. A static line breaks under pressure, while a dynamic probability channel accurately wraps the data. The engine captures percentage displacement from 30 sessions, constantly recalibrating to locate true volatility boundaries. Processing rolling standard deviation math during a live high-speed session is difficult. To make the data instantly actionable, we translate this architecture into an airport runway and flight navigation methodology. Price action is organized into 4 distinct spatial zones: taxiing, terminal fog, overhead airspace, and decompression fields. Converting these statistical equations into spatial zones establishes a consistent framework for decision-making. It replaces the ambiguity of manual charting with fixed rules for when to stay grounded and when the airspace is clear. By mapping volatility this way, you move from reacting to price spikes to observing how price interacts with pre-calculated probability zones. This allows for a more systematic approach to identifying institutional order blocks. We start building the model on this bare chart. A heavy, solid white line generates at the exact opening bell print, marked Lock CP. This is the absolute starting axis for the session. This is the runway center line. Every intraday trend is simply a measurement of displacement from this specific point. Until enough capital is injected to force a breakout, price is just taxiing up and down this axis. At the opening print, the engine generates an immediate noise filter. A semi-transparent gray rectangle labeled B-chop envelopes the center line. This automated box calculates the exact spatial distance between the session open, the prior session close, and the central midpoint. We call this the terminal fog. It represents a low-direction, high-volatility cage entirely devoid of expansion fuel. Mathematically quarantining this zone protects your capital. It prevents you from taking damage from random, stop-hunting wicks before true institutional volume actually arrives. Outside the fog, the model calculates the standard operational limits for daily order flow. Solid red and green parallel lines render above and below the gray box. The red line is calculated by taking the opening print and adding the historical mean upside move from the past 30 sessions. Labeled Lock H1, this boundary serves as the standard expected flight path ceiling for any bullish expansion. The downward equivalent, Lock L1, subtracts the historical mean downside move from the open, establishing the expected structural floor. These primary lines are heavily targeted by algorithms for daily mean reversion scalps. They define the standard playing field. During aggressive trend days, volume pushes price beyond standard limits. To capture maximum statistical expansion, heavy crimson and lime green lines appear at the extreme outer edges of the chart structure. The upper crimson line, Lock H2, is generated by adding a full standard deviation multiplier to the historical mean ceiling. The lower lime green line, Lock L2, subtracts that same multiplier, defining the maximum statistical decompression floor. When price reaches these outer markers, the asset has stretched past 95% of its historical statistical variance for a single session. Its directional momentum is exhausted. Trend followers routinely get trapped here. These extreme lines represent strict no-fly zones, marking the precise perimeter where market makers run out of liquidity. The most critical operational zones within the DRW framework sit in the empty space between these major boundaries. A dashed fuchsia line generates here, bisecting the total distance between the H2 and L2 extremes. Labeled Lock C mid, this acts as the rolling gravitational axis, bridging the ultimate bullish and bearish limits. If price anchors above this specific axis, the bulls hold structural market control. If it drops below, the bears actively possess the field. Between the standard expected means and the standard deviation extremes, thin dotted lines appear. While retail traders panic when price breaks past the initial H1 or L1 lines, institutional algorithms are actively targeting these dotted mid-levels. They serve as magnetic acceleration checkpoints. Once price enters the liquidity vacuum beyond the standard expected mean, it gravitates directly to these midpoints. Retail traders watch the major, thick boundaries. Institutional snipers balance their order blocks on these exact invisible midpoints. Watching this live price action sequence, you can see candles violently ping-ponging, entirely trapped inside the gray B-chop rectangle. Attempting to forecast a directional trend while price is confined to this box destroys trading accounts. It is pure retail noise. The long ignition sequence requires strict confirmation. A full timeframe candle must close entirely above the upper edge of the fog. This clean close provides mathematical proof that institutional buying power has overwhelmed the retail noise. The moment the plane clears the fog, you map the immediate upside target trajectory, striking the H1 ceiling and hunting the lock mid H12 acceleration checkpoint. Waiting for the strict gray box escape criteria removes emotional guesswork from low-volume market chop, replacing hope with mechanical probability. The most lucrative algorithmic trap in the DRW framework occurs at the extreme statistical boundaries. Notice how price rockets upward, pierces the heavy crimson lock H2 line with a single wick, and then closes immediately back below it. By the time price collides with the outer H2 or L2 terminal, the order book is completely depleted of directional momentum. Seeing the aggressive upward move, retail traders assume a breakout is underway and initiate long positions at the exact statistical top. This exhaustion pierce executes the terminal fade. Algorithms hunt trailing stops with a fast wick, then slam the price back inside the boundary. With the runway effectively out of space, the market forces a cascading reversion, snapping price directly across the airspace back toward the center pivot centerline. The mathematical variance boundary protected you from buying the false breakout, while simultaneously providing the exact trigger to execute a reversal. Replacing manual lines with rolling mathematical boundaries aligns your execution logic with the statistical parameters used by high-frequency market makers. It turns the chaos of intraday volatility into a structured map of high-probability outcomes.